Hey, what's up everyone, and welcome to the School of Personal Finance. So now this is the third video in the Everything You Need to Know About 401k Plans series. In this video, we're going to talk about taking loans from your 401k, taking hardship withdrawals, and also just taking distributions, trying to withdraw money from your 401k plan. If you haven't seen the first two videos, we talked all about if you should contribute, how much you should contribute, all about asset allocation, picking the right funds in the 401k. So make sure to go back and watch those videos as well. I hope you find this one helpful. Let's get to it. If this is your first time here, my name is Rich McCormick. I'm a certified financial planner. I've been a financial advisor for over 20 years, and this channel is all about teaching you personal finance and how to become great with money. If you enjoy these topics, please hit that subscribe button and go check out schoolofpersonalfinance.com. All right, so we are going to talk about loans, hardship withdrawals, and taking distributions from your employer-sponsored retirement accounts. So now this goes for 401ks, 403bs, 457 plans, and where we're going to start is that each employer plan is different. So you have to make sure to check with your employer to see what the rules are surrounding these different types of options that you might have. No plan is the same. So some plans might offer hardship withdrawals or loans while other plans might not. So you really need to contact your HR department or whoever is the record keeper for your 401k or 403b plan and understand exactly how it works before you take any action. All right, so let's start with loans. And I'm gonna keep saying 401k, but I also mean 403b and 457 plan as well. But let's start with the pros and cons of taking out a loan and how it works. So now when you take a loan out of your 401k plan, the maximum that you could take out is going to be the lesser of $50,000 or half of your account balance. Let's just do a very quick example. If you have $80,000 in your 401k and you want to take out as much as possible in the form of a loan, then the max you'll be able to take out is 50% of that account value, which is $40,000, right? So the lesser of $50,000 or half of your balance. If you had $500,000 in your 401k, then the maximum you could take out would be that $50,000, right? You can't take $200,000 out. They put a cap on it at $50,000, but you can't take any more than 50% of your vested account balance. And there's no credit check. Your credit score doesn't matter. If you have bad credit, you're not going to get denied for a loan from your 401k because you're borrowing your own money. It's typically just an application, and then you have to wait a little while for your 401k provider to actually process the loan. And a lot of times there are some small fees that you want to know about. They might have an application fee, or they might have an annual fee to service the loan, so you want to look into that as well. And now the typical repayment period is between 1 and 5 years, and you could choose whatever repayment period you want. Now, if the loan is for the purchase of your primary residence, then many plans will allow you to extend that repayment period, 15 years, 20 years, all the way up to 30 years. So you want to check with your plan to see how that works. I actually took out a 401k loan when I bought my house back in 2011. We built our house and I needed the funds to continue building the house, and I was able to take out a 401k loan over a 15-year period. I just had to send them a contract basically showing them that I was using it for my primary residence. And now the typical interest rate on the 401k loan is going to be around prime plus 1%. So we're close to 10% right now on these types of loans. But again, each plan is different. So you have to check to see what your plan charges in interest. Now, when you repay the loan, it's going to come from payroll deduction. They're going to deduct the payments directly out of your paycheck. So your paycheck is going to get reduced. And then the interest that you are charged, that goes back into your account. So you are repaying yourself. All right. So this is another pro with taking a loan from your 401k. You're not paying the bank interest. You're borrowing your own money. It's like you're acting as your own bank. So you are paying yourself back that interest amount. So now the things we went over so far, they all make it sound pretty nice to take out a 401k loan, right? The process is pretty painless. You're paying yourself back. It's a pretty easy way to get your hands on money. And odds are your 401k is probably the largest asset that you might have right now. So to be able to borrow money from it and take care of other things, it sounds pretty appealing. And once I go through the negatives, I'll give you my overall opinion. As I already shared, I did take a 401k loan out in my own life. So everybody does have a different opinion, and it really depends who you're listening to. So I'll share mine as well. But now let's go into some of the downsides, some of the negatives to taking out a loan in your 401k. All right, so the first one, and probably the biggest one, is that when you take a loan, you're taking the money out of the investment. You're taking it out of the market so that you could go ahead and go use it. So there's an opportunity cost for that. Now, if you could time it right and you take out a loan at the top of the market and the market goes down for the next 5 years, then in hindsight, that would have been the good thing. But over time, markets tend to grow. All right. So as your money is out of the market, you are missing out on the growth of that 401k money. So this could end up costing you big time over a long term, especially if you take out a loan over a 15-year period for the purchase of a primary residence. Then that's a long time that money is out of the market, and you're only putting it back in through your payroll deduction. Another thing that you need to check with your employer about is if they'll allow you to continue to contribute when you have a loan outstanding. In my experience, most plans still allow you to contribute to that 401k plan. But that's a big deal. If you can't contribute anymore and you're missing out on an employer match, then in my mind, that makes it much worse taking out a loan against your 401k. So you want to make sure that you're still able to contribute to that 401k, even though you have a loan outstanding on it. So now defaulting on the loan, it gets very ugly from there. So you do have to make sure that you are able to pay it back. If it's through payroll deduction, then you don't really have a choice, right? But if you get billed separately or however it works, you just need to make sure that you keep up with those loan payments, because if you do default, then it becomes a distribution where you're going to owe ordinary income tax on that amount. And also, if you are younger than 59 and a half, you will have a 10% penalty on that distribution as well. So you could get smacked upside the head with a really large tax bill just because you weren't able to make those loan payments. And odds are, if you couldn't make the loan payments, then you probably don't have that money to pay those taxes. So you could really put yourself in a tough situation if you don't keep up your end of the bargain with that loan agreement. Now, another thing that you really want to understand is what happens if you leave your employer. All right, so you need to check with your plan. If you get fired, if you decide to leave your job, change careers or whatever, and you have a loan outstanding, that loan, it could become a distribution where, again, you would have to pay ordinary income taxes and the 10% penalty if you're younger than 59 and a half. Some providers, they do allow you to continue to leave your 401k there and continue paying that loan back, even though you're not employed there anymore, but you need to check with the plan. Another thing to keep in mind is that you can't take a loan from an old employer. So if you have an old 401k that's hanging out there, then you can't take a loan against it. What you might be able to do is take that old 401k and roll it into your new 401k plan and then take a loan against it. But you can't take it from that old plan once you leave that employer. So do I think it's a good idea to take a loan out of a 401k? And my answer, like with most things, is it really depends on your situation. So if you're taking a loan out for a purchase of a home and you need it for the down payment, right? Then again, depending on where you're at financially, I don't think it's a terrible move. You just have to go in eyes wide open and understand that your paycheck is going to be reduced. So not only are you going to have this mortgage payment now, but your paycheck is also going to be reduced. And if you change jobs, if something happens where you might have to come up with that payment and satisfy it, or else it's going to be a distribution, then that's a big risk. So I think it really depends on how much you need, how long you're able to take the loan for, and what happens if you do change jobs or if you get fired, God forbid. All right, so now if you're taking out a loan to pay off credit card debt, then I think it's a good thing to pay off 30% interest credit cards using a 401k loan that might be at 8 or 9% where you're paying yourself back the money. But if you run up the credit cards again, now you just took away one of your lifelines, right? This 401k loan, I look at it as like a backup to the backup of my emergency fund. Only in a worst case situation do I really want to tap into that. And if you use it to pay off bad debt, high interest rate debt, but you don't change your behavior, then you could really bury yourself. But if you have a real emergency in life, if you have medical bills, if something comes up, then having that lifeline there, I do think that it's a good thing. I don't think that it's terrible. I'm not in the camp of never take a loan from your 401k, but you have to understand that it really could put a damper on your retirement, right? Because you're taking that money out of your account, it's not growing, and you're missing out on that. And if your plan doesn't let you continue contributing, then it makes it much worse, in my opinion. All right, so now let's look at hardship withdrawals. So now the IRS defines a hardship withdrawal as money that you need to take out to satisfy an immediate and heavy financial need. And there are 7 different circumstances deemed by the IRS to be considered an immediate and heavy financial need. So I'm just going to go ahead and read them off to you very quickly. So the first one is medical expenses for the employee, the spouse, or their dependents. The second one is the cost to purchase a primary residence. The third one is tuition or related educational expenses for the employee, the spouse, or their dependents. The fourth are payments to prevent eviction or foreclosure on a mortgage. The fifth one is going to be for burial costs for your spouse or dependent. The sixth is repair of damage to the employee's primary residence. And the seventh is expenses and losses that are the result of a FEMA declared disaster. And now the amount of the hardship, it can only satisfy that immediate need. You cannot take out anything above that, all right? It can include the taxes that you will have to pay because of this hardship withdrawal. So with hardship withdrawals, you do have to get approved. You do have to send in documentation proving that you have an actual hardship, all right? And the HR department, they have to go through the process of approving it and then sending you out the money. Now, when you receive the money, you are not able to put it back into your 401k plan like you are with a loan. So the loan should always be the first option. If you don't have the option of taking out a loan, then that's where the hardship withdrawal will come into play. But once you take that money out, you can no longer put it back in, and you are going to have to pay ordinary income tax on that hardship withdrawal. Now, in some cases, you might also owe a 10% penalty. It's going to depend on what you are using that hardship withdrawal for. All right, and then let's wrap this up by talking about just taking distributions from your 401k plan. All right, so now the magic age for taking withdrawals or distributions from your 401k is 59 and a half. Once you reach 59 and a half, you could take a distribution without the 10% penalty, right? You're still gonna owe ordinary income tax on those distributions unless you have Roth money. If you have Roth 401k money or Roth 403b money, then those distributions will come out tax-free as long as you follow the rules for the Roth distributions. But now there is one rule that many people are not aware of, which is called the 55 and retired rule, where if you retire at age 55 or older, you are allowed to take distributions from your 401k plan or your 403b plan without that 10% penalty. You're still going to owe ordinary income taxes, again, unless it's a Roth, but you will not owe that 10% penalty. So for people who decide to retire at age 56, they could start taking 401k withdrawals and not be subject to that 10% penalty. Now, another type of distribution is what's called an in-service distribution. So let's say, for example, you work at a company that offers in-service distributions. Then even though you're still working there, you might be able to take your 401k balance and do a rollover to an IRA if you'd like to. Some people like to move it from a 401k to an IRA because they have more control over the expenses, the investment options. They can move it to a place like Schwab or Fidelity or Vanguard and control how much it costs them to invest in different funds and have many more funds that are available to them. So that's called an in-service distribution. All right, everyone, that is it for this one. I hope that you found that helpful. Please make sure to hit that like button if you enjoyed it. Subscribe to the channel if you are not subscribed already. Go check out schoolofpersonalfinance.com, and I will see you again in the next one.